Good day, students. Once again, this is another video that I will be doing on the topic of mainly preferences and also ordinary shares, and the redemption of preferences, which is a very crucial topic for students to understand. And I will be doing question 4 of this question paper. And let me say this, if time allows me, then I will do the note for this and the note for the other question on a separate video, which will be a shorter video. Then I'll just focus on the note and perhaps the taxation ledger account, where you deal with the first and the second provisional calculation or payment of tax. And I will do that perhaps on a separate video if time allows me. So now let me go to question 4 straight. It says Coco Limited was incorporated with an authorized share capital of 2,500,000 no par value shares. That means the company had 2,500,000 no par value shares. That means this company was authorized to issue up to 2.5 million shares, which are ordinary. That means they must not exceed 2.5 million shares. And 750,000 10% cumulative or 10% redeemable shares of no par value. And meaning that when we declare preference dividends, we will calculate 10% of the capital that is invested in terms of preference dividends, and 10% of that will be preference dividends for that specific period. 750,000 preference shares are the shares that were authorized. It does not mean that they are all issued. There must be an instruction that tells us how many preference shares that were issued. Then it further says that the preference shares can be redeemed at the option of the company. The company has a financial year end 28th of February each year. So now the accounting period is the 28th of February. And it says on the 1st of March in the year 2009. We don't know the accounting period that we are dealing with, but we know that on the 1st of March 2009, which is the beginning of the current financial year. That means we are in the 2010 accounting period, because the 2010 accounting period started on the 1st of March 2009. That means obviously we are dealing with the year 2010 accounting period, started on the 1st of March 2009, and it will end on the 28th of February in the year 2010. The following shares were already, take note of that, they were already issued. That means these are the shares that were issued prior years or in the previous years. By the beginning of the current year, these shares were already issued. Therefore, it means they will have to be recorded as an opening balance. Then now we have 800,000 ordinary shares amounting to 2,500,000 rands. That means the company issued 800,000 ordinary shares, and the total, which is capital, amounted to 2,500,000 rands. That means these shares were issued at 2,500,000 divided by 800,000. That means this tells us that these shares were issued at 3 rand 13 cents if we were to calculate the issue price of these shares. So now that will be 3 rand 13 or 12.5 cents. So now this is the price, but we don't need the price. I just want you to see how do we calculate the price backwards. Then now we continue and we say 300,000 10% redeemable cumulative. Take note of that cumulative. It means if the preference dividends were declared in the previous year and they were not paid, therefore now they will have to accumulate and be added on the preference dividends that are to be declared and be paid in the current accounting period. Then now they say 300,000 10% redeemable cumulative preferences were issued at an issue price of 4 rand. That means out of the 750,000 preference shares that were authorized, is only 300,000 that was issued. That means we were only focusing on the 300,000 of the preference shares that were issued as opposed to the total that was authorized. Therefore, now they were issued at 4 rand. Therefore, now if they were issued at 4 rand, we can calculate how much would have been the total capital for these preference shares. So now that will be 4 rand times by 300,000. Then this will give us 1,200,000 of the preference capital. That means the capital for the 300,000 preference shares that were issued at 4 rand would have amounted to 1,200,000 rands. Then after, it further says that we have the additional information that we have to account for on the 1st of February 2010. And when it comes to preference shares, let me emphasize this. When it comes to preference shares, dates are very important because your answers can be incorrect because of not taking into account the date of the occurrence of the transactions. So now they say on the 1st of February 2010, the board of directors had a meeting and passed a resolution to redeem the issued 10% redeemable cumulative preference shares at a premium of 20 cents per share on the 28th of February 2010. So now we are given the date in which the redemption took place. A decision was passed by the board of directors on the 1st of February, which is a month before the end of the current accounting period. However, the redemption actually took place at a premium of 20 cents, and that was at the end of their current accounting period, because the current accounting period ends on the 28th of February 2010, meaning the redemption took place at the end of the year. And if the redemption takes place at the end of the year and we have to take into account the preference dividends, it means preference dividends will be 10% of the amount that is being redeemed. 10% will be calculated from that, and that will give us the preference dividends for the current year. Then if there are preference dividends that were accrued last year, because these are cumulative preference shares, then we have to add those preference dividends all together. Then that will give us the preference dividends that are to be paid to the preference shareholder at the end of this accounting period when the redemption takes place. So now we know that 10% of 200,000, which is 10%, multiply this by 200,000, it will give us preference dividends for the year. 1,200,000 times by 10 divided by 100, this will give us 120,000 rands. So now that means 120,000 rands will be preference dividends. If I may write that in abbreviation, PD, this will be preference dividends for the current year. Therefore, now if there are those that were accrued from last year, then it will be the same 120,000. Then we have to add the two. Then that total becomes total cumulative preference dividends by the end of the current year. Then after, it further says that, and let me just highlight this before I continue. We are given our premium in rands. Take note of that. Premium is given in rands as 20 cents. And they say 20 cents per share always. Whenever the premium is given in cents, they will or in rands, they will always say per share. It means your premium must be calculated on the number of shares that are being redeemed. Meaning in this case, we have 300,000 preference shares that the company had issued, and all of them are being redeemed. Therefore, now in that 300,000, we'll say 300,000 times by 20 cents is 0.2, and that will give us 60,000 as the premium at the redemption. That means our premium will be 60,000. So now premium will be an amount of 60,000 rands, which is 300,000 times by 20 cents. That will give us 60,000. This will be a premium at redemption. And now, very importantly, it's not always the case that your premium will be given as in rands. Your premium can sometimes be given as a percentage. if let us say, because 20% is the same as 5%, but that is not something you must be worried about, where you have to convert a premium in rands into a percent. So now in this case, 20% is the same as 5%. I calculated this behind the scene. Please don't worry much about that. So now if you are given a premium as 5%, they are not going to say 5% per share, because a percentage of a premium is calculated on the capital that is being redeemed. And the capital in terms of preference shares that is being redeemed is the full 1,200,000. So now if the premium was given as 5%, please calculate it from the capital that is being redeemed. And in this case, our capital is 1,200,000 that is being redeemed. Then we multiply that by 5, we divide that by 100, it still gives us the same 60,000 rands. So now either the premium is given as in rands or given as in percentage, at the end of the day or at the end of the calculation, the premium will come up to the same amount. So now either your premium in this case was given as 5% or 20 cents, you still get the premium of 60,000, which is the premium at the redemption of the 300,000 preference shares. So now that is a very critical thing that you must take into account, that whenever you are given your premium as a percentage, you calculate that premium from the capital that is being redeemed, in this case, which is 1,200,000 rands. So now let us move on that same note and highlight everything, guys, that I am adding in this exercise, which is not here, because there are a lot of things that I want to add today which are not in this exercise, because I want to open your mind in terms of the probable or possible questions that you might be tested in any exam with regard to preferences. So now secondly, in this case, they told us that the board of directors passed a resolution to redeem the preference dividends, and these preference dividends, we said that all of them are being redeemed. So now if they are all being redeemed, then we need to take into account the fact that it's not always the case that preference shares will always be redeemed, all of them. So now that means I just want to bring you into a scenario where, let us say, if they say only 70% of the preference shares are being redeemed. In this case, they said redeem the issued 10% redeemable preference shares. They said they issued. How many preference shares were issued? We know that the preference share that were issued, it was 300,000. So now they say redeemed the issued. That means all that was issued must be redeemed. That means they are redeeming all the preference shares. So now I want to bring you into a scenario where only a certain portion of the shares is being redeemed. If let us say they had said that 70% was redeemed, this is my own scenario, please understand me. If 70% was redeemed, because it's not always the case that all the preference shares that were issued will be redeemed. If only 70% was redeemed, listen to this very carefully. If they said that only 70% or say redeemed 70% of the preference dividends, that will mean that we have to go and calculate 70% of the preference shares that were issued. Then it will mean we have to say 300,000 shares, multiply that by 70. Therefore now that will give us 210,000. Therefore now 210,000 will be the number of shares that will be redeemed. If, please listen to me carefully, if only 70% of the preference dividends were being redeemed, then we'll have to say the number of preference shares that were issued times by 70% to get to 70% of the preference shares that are being redeemed, which is 210,000 shares that would have been redeemed if only 70% was being redeemed. Then after, what do you do next? You still go and you calculate your premium. Now remember, in this case, the premium would have been the same 20 cents. Then that premium will be calculated on the number of shares that are being redeemed, not on the total preference shares that were issued. Only a premium is calculated on the number of shares that are being redeemed. Meaning now the 20% will have to be calculated on the number of shares that are being redeemed, 210,000. as opposed to 300,000, which was the total number of shares that were issued. Please take this into account, guys, because I don't have an exercise that has this scenario where I have to calculate the number of the portion of the preference shares that are being redeemed. So now that means, again, the 5% scenario that I've given to you, the 5% of the premium, if the premium would have been given as 5%, which is the percentage, therefore now this will have to be calculated on the capital that is being redeemed. Remember, in this case, the capital that is being redeemed will not be 1,200,000. Capital that is being redeemed, in the case of 70%, it will not be the 1.2 million, but it will be 210,000 shares times by 4. Where is the 4 coming? Is the issue price, because our preference shares were issued at 4 rand per share. So now we'll have to say 210,000, which is 70% of the shares that in this case would have been redeemed. Then we'll say 210,000 times that by 4. Therefore now this will give us the total of 840,000, which is 70% of the capital. If you wanted, you could have said 1,200,000, which is the total of all the preference shares, which is that 1.2 million. You can say that you multiply that by 70 divided by 100 to get to the 70% of the preference shares that would have been redeemed, or 70% of the preference capital that would have been redeemed. Therefore now from this capital, which is 70%, then you can say now multiply this by 5% if the premium would have been given as a percentage. Then if the premium would have been given as in rands, then it will be 20 multiply that by the number of shares, which is 70% of the total preference shares that is being redeemed. Therefore now that will be your premium in that case. So now please take that in very careful account. Therefore now 840,000 would have been times by 5 divided by 100, then the premium would have been 42,000. Similarly, if it's 20 cents, 0.20 times by 210,000, we still get to the same amount, 42,000 rands in terms of the premium, if 70% of the preference shares were redeemed. Get me careful, this is not in this question. I just want to stress on this and emphasize on this because it's very important. And now I am passing, I will not do the scenario. Make sure that whenever you practice, you think of the scenario where only half of the preference shares were redeemed, or maybe 60% was redeemed. And in the case where the premium is a percentage, that is very important. I'm highlighting this for a very important reason. You might remember me when you write the exam, when you see these scenarios. So now we have 1.2. 1.2 says declare the preference dividends for the year 2009 financial year and year 2010. So now it means in the previous year, which is the year 2009, there are preference dividends that were not declared, but they were supposed to be declared. So now the company in the year 2010, they are declaring dividends for the last year 2009 and the year current year. Remember, these shares are cumulative in nature, or that these preference shares are cumulative in nature. That means preference dividends for the last year that were not declared will have to be added in the current year. Therefore now we add both of them, they become totally cumulative preference dividends for the current year. Then it says the dividends payable for both financial years will be paid to preference shareholders on the 28th of February 2010. No further cumulative preference dividends were accrued. That means now we only have to account for the preference dividends of the year 2009 and the preference dividends of the year 2010, and we combine all of that, then we pay to our preference shareholders at the end of the current year ending 28th of February 2010. Then after we continue on that same note, so now let us just calculate our preference dividends. In this case, for the 2 years, we know that our capital is 1,200,000. And from there, we multiply that by 10% because these are 10% redeemable preferences. And we realize that our preference dividends, as I highlighted, our preference dividends is 120,000 rands. So now we say times by 2 because it's for 2 years, 2009 and the year 2010. So now if you multiply that by 2, it will give us 240,000 preference 240,000. That will be the total preference dividends that will be recorded by the end of the current year. Multiply that by 2, it gives you 240,000 preference dividends for the year 2009 and the preference dividends for the year 2010, which is the current year. So now we continue on that same note, and it says that under number 2, the capital, premium, as well as all, not some, as well as all the preference dividends payable on these shares will be financed as follows. It means when the redemption takes place, which is the end of the year, because we know that the redemption took place on the 28th of February in the year 2010, where the directors passed a resolution to redeem the cumulative preference shares on the 28th of February 2010. So now when the redemption takes place, remember we are redeeming the full capital. How much the preference capital? 1,200,000 rands. There is the amount. So now whenever we redeem the capital back. In this case, we redeem the full capital. If it was 70% of the capital or the shares that were being redeemed, that means only 70% will be recorded as the redemption of the capital in terms of preference. But in this case, all the preference shares were redeemed. That means all the capital will be redeemed. Don't forget that if it was 70%, only that 840,000 will be accounted for. Then after we add the premium, and we know that our premium is 60,000. We calculated the premium, and we said that if the premium would have been 5%, 0.05, it will be multiplied from the capital that is being redeemed, which is 1,200,000 rands. That means it will still be 60,000. However, our premium is given as 20 cents, which is in rands. And when your premium is in rands, they will always say per share. That means you calculate it from the number of shares. That means you say the premium, multiply that by the number of shares that are being redeemed. In this case, all the shares are being redeemed. Therefore, now we multiply by all the shares. Therefore, now it will be 0.2 times by 300,000. Then that will give us 60,000, which is our premium. Then after we add the preference dividends, and our preference dividends is 240,000, because we know that preference dividends per year is 10 to 120,000 for 2 years. Then that will give us 240,000, because they said the capital, premium, as well as all the preference dividends payable on these shares. So now it means the total amount that we need to raise for the preference shareholder, it will be 60,000 plus 240,000 plus 1,200,000, and this will give us a total of 1,500,000, which is amount to be raised. In case if there is no money available, we need to raise a total of 1,500,000 rands. So now so far that is what we know. They further tell us that the payment of the capital, premium, and also the preference dividends will be financed out of. They say financed out of. That means that there is no money available. So now if there is no money available, we need to raise the money so that there is money available to pay this 1.5 million. And immediately when there is money available, then after we can make the payment. So now how do we raise money? They say loan from Odo Bank for 1,050,000. So now they say we need to raise a loan from Odo Bank, and when we raise the loan, they say the loan must be limited to 1,050,000. That means now we have to say out of the 1,500,000 that we owe this amount, we need to subtract the loan now and say less 1,050,000 of the loan, because we know that we have to raise the loan of 150,000. Then after we say less 1,050,000, and we see how much is the remaining balance. So now the remaining balance is 450,000. That still need to be raised. And they say now out of that balance, there is cash available of 135,000. So now there is 135,000 that is available. Obviously, we don't need to raise that. It's already in our bank account. So now let us subtract the cash that is available. I'm just doing this as my workings. cash available in the bank is 135,000. So now after we have took the cash available, let us check how much do we still have to raise. Minus 135,000. Then we see that there is still another balance left again, 315,000. There is 315,000 that still needs to be raised in order for us to get to the total of 1,500,000, which is the payment to the preference shareholder because of the redemption of these preference shares. Remember, redemption is when you buy back shares. So now in this case, when the company is buying back these shares, they realize that they don't have money to pay the preference shareholder, because when you buy something back, it means you have to pay money to that person. No one buys without money unless you buy on account. So now in this case, the company says that they are buying back the shares from the preference shareholder. However, they don't have money to buy these shares, or they don't have money to pay the preference shareholder in order for them to redeem back the preference shares that were issued to the preference shareholder. So now they say we must raise money. That is why we are raising all these funds. So now the balance that is still left is 315,000. So now this balance is still not enough. How are we going to raise this money? That is the question. There will always be instruction. We have done the first instruction, second instruction, therefore now we are in the third instruction. They say the balance, that is the balance that we have, the balance that is left now, that still need to be raised. The balance from the fresh issue of the ordinary shares at 3 Rand 50 cents per share to existing shareholders, in proportion to their prevailing shareholding. And they say right issue. So now this is the right issue, shares that are being issued to existing shareholders at a price lower than the market price, but they don't specify that is lower than the market price, but we know that is the right issue because they clearly stated that it is the right issue. However, if the market price was given and it was higher than the issue price, then we'll surely know that this is a right issue. So now we ask ourselves then, how many shares must be issued in order to get the capital of 350,000, or in order to get the money of 350,000? We know the capital that must be raised and we know the price. Then we can calculate the number of shares. Let us check how we can do that. So now the number of shares, which is the number of shares, it will be the capital, because we need to raise the capital, because whenever you issue shares, capital is always affected. In this case, it will be ordinary stated capital. Therefore, now we know the capital is 315,000. Then we say 315,000. We divide that by 3 Rand 50 cents. And the minute we do that, this will give us the number of shares that need to be issued in order to get to the capital of 315,000. 315,000, divide that by 3 Rand 50. That will give us 90,000 shares. This will give us 90,000 shares. So that means the company will have to issue 90,000 shares at the price of 3 Rand 50 so that they get to the capital of 315,000 rands, which is the balance that is still left that need to be raised. So now same applies. If you say 90,000 shares times by 3 Rand 50 cents, which is the share issue price, that will give you obviously 350,000. So now all the funds have been raised in this case. Then now we can continue to the next transaction. Please take note of these workings, guys. They are very crucial. Then under number 3, it says that the directors were satisfied that the company's assets were fairly valued and exceeded its liability, and they were also satisfied that the company will be able to pay its debt as it becomes due. Assume a dividends tax rate at 15%. So now that means we have to take into account dividends whenever we declare the preference dividends, and also when the payment takes place, we also have to pay the dividends tax which is due to SARS, because the company is just withholding the dividends tax on behalf of SARS. So now we have done that, or we'll do that. Then after it says all transactions decided upon by the directors at the meeting on the 1st of February, that was the meeting, remember, on the 1st of February, they passed a resolution. They say all the transactions that took place there or took place as expected. So now whatever they decided, it was processed very well, and everything was done on the 28th of February 2010. By the end of the year, the redemption, the declaration of preference dividends, then everything was done. Funds were also raised, then payments also took place. And they say in addition, Cocoa Limited paid the full amount due to the preference shareholders, as well as the revenue as the receiver of revenue or revenue service on the 3rd of March in the year 2012. So now this becomes very important, because they are telling us that the payment to the receiver of revenue took place on the 3rd of March in the year 2012. However, I will just ignore it now, because I will not be doing the extract of their statement of financial position. So now we know that the payments took place as they supposed to. Then after, it further says that under number 5, on the 28th of February 2010, ordinary shares were issued. And they say refer to additional information number 2. This number 2, and we know that under number 2 we issued shares, which was 90,000 shares here at the bottom, and that was the issue price of 350. Then that became 350,000 rands. Then after, we are told that share issue expense of 12,000 was paid out of the available cash resources. So now there was a share issue expense that was paid out. Then after, it says the retained earnings had an opening balance of 80,000 rands. Retained earnings had a balance of 800. It is 800,000 rands. That is not clear. Retained earnings had a balance of 800,000 rands. Let me just clarify that. It is 800,000 rands. So now that retained earnings, we know that it will be an opening balance when we do the statement of changes in equity. 800,000 rands. That is our retained earnings that we have to account for. Then after, they say at the beginning of the accounting period. So now they make it very clear that it was at the beginning of the current financial period. That will be an opening balance when we do the statement of changes in equity. Take note of that too. So now let us continue on that same note to where now we are looking at doing what is required exactly. Only 2 entries, then after we are done. Then it says total comprehensive income for the year 2010 financial year amounted to 760,000 rands. And the minute you are given total comprehensive income, there is a possibility, if there was revaluation, that the revaluation is already included. If there was a revaluation, if there is no revaluation, please worry not. But if they say total comprehensive, then look if is there any revaluation. If there's no revaluation, then you do nothing. But if there's revaluation and you do the statement of changes in equity, you need to remove the revaluation from the total comprehensive, and you record that revaluation in its own column. And the difference between total comprehensive and the revaluation will go under the retained earnings. I've emphasized on that in the previous video that I did. Then after, the last journal entry before we do what is required says to us, on the 28th of February 2010, it was decided that take note of that fully paid up shares, let me circle that in red, fully paid up shares. And fully paid up shares are the shares that are fully paid up. As the term says, that fully paid up shares are the shares that are fully paid up. So now that means the company will pay the shares on behalf of the existing shareholders who were on the share register on the 31st of January 2010. That means the company takes money out of their own reserve. They buy shares on behalf of the existing shareholders. That means now the company will take their own money. They will not receive any cash. Therefore now, whenever we record this journal entry, if it's required, bank will not be affected, because the company will take money out of their own retained earnings, or out of their own reserves. That is why whenever you have capitalization issue. This is called the capitalization issue. Whenever there is the capitalization issue, you always debit the retained earnings because the money was taken from the retains of the business or from the earnings of the business. Then after you credit ordinary stated capital because this was ordinary capital. Then it will be ordinary stated capital. Then after that, the journal entry whenever you are dealing with the capitalization issue. The capitalization issue is when the shares are issued for free to the existing shareholders. Take note of that. At the same market price. And now let me emphasize on the date when it comes to this transaction because it is very crucial again. They say on the 28th of February 2010, the company decided for a fully paid up shares to the existing shareholders who were on the share register on the 31st of January in the year 2010. Now, the emphasis of this date is very crucial for one major reason because there are shares that were issued during the year. Remember, during the year, we issued some shares in order to finance for the redemption. And those shares were how many? 90,000 here at the bottom with the blue one. 90,000 shares were issued in order to finance or in order to raise money for the payment of the redemption of the preference dividends. So now we issued 90,000 shares. However, the 90,000 shares were issued when? Let us go and check. The 90,000 shares were issued at the date which is on the 1st, remember this is additional information, on the 1st of February 2010, take note of that. On the 1st of February 2010, the board of directors had a meeting and now they passed a resolution. Remember this is the 1st of February. And now in this case, when this entry took place, it was the 1st of February, 1st of February, 1st of February. Let us go and check under number 8. Under number 8, they say to all the shares that were in the share register when on the 31st of January. So now obviously when this issue took place, which is the issue on the 1st of February, when this issue took place, it was already after the 1st of after the 31st of January, because the 31st of January is before the 1st of February. So now that means when we calculate the number of shares here, we must not include the shares that were issued on the 1st of February, which is a day after, because this is the 1st of February. And they say to only shares that were in the share register when on the 31st of January. And 31st of January is before the 1st of February, meaning now these shares, which is the 90,000 shares that are here at the bottom, will not be accounted when we calculate the number of shares to be issued as the capitalization issue. Take note of that. It is very important, guys. I'm emphasizing because I know you might be tested on such. So now that means if this entry, let me just give you the other side of the coin. If this date was let us say the 28th of February, then obviously the 28th of February is after the 1st of February. That means now this entry will have to be ignored. So now that means this entry will be applicable in this case because 1st of February is before or would have been before the 28th of February. That means now if this date was the 28th of February 2010, therefore now these shares, which is the 90,000 shares, will have to be added when we calculate the number of shares to be included in the calculation of the capitalization issue. However, in this case, the date is the 31st of January, and the shares that were issued as right issue shares, they were issued after the 31st of January, which is the 1st of February. So now 90,000 shares will not be included when we calculate the number of shares here. So now they said these shareholders will receive 1 share for every 4 shares. Then how many ordinary shares were issued up to the 31st of January? We only know that the shares that were issued, it is 800,000 ordinary shares that we have in the share register that were already issued by the 31st of January, because these shares were not yet issued by the 31st of January. So now that means the 90,000 will not be accounted for. So now when we calculate these shares, it means we'll only have to say 800,000 shares that we see under the first columns there, 800,000 ordinary shares that were in the share register on the 31st of January in the year 2010, because these shares were issued by beginning of March 20.9, beginning of the year. These shares were already in the business. They told us that. So 800,000 times by 1 divided by 4. And I said whenever the entry says for every, and in this case they said for every 4 shares, they will receive how many shares? 1 share for every. And whenever they say for every, you divide by for every. In this case, for every 4 shares. That is why we divided by 4. We said 800,000 of the shares that were already in the share register by the 31st of January, and we divide that by for every, which is for every 4 shares, and it gives us 200,000 shares that will be issued as the right issue shares. So now there is 200,000 right issue shares. Sorry, capitalization issue shares. Sorry, it's not the right issue. That will be capitalization issue shares. Capitalization issue shares, which is shares issued for free to the existing shareholders. And at what price were they issued at? That is number 8, the last sentence. They were issued at the market price of 4 rand. Therefore, 200,000 times by 4, that will give us 800,000 that the company will have to pay for free to the existing shareholders. It is very good, guys, to be a shareholder. Please buy shares and you'll enjoy eating money at the end of the accounting period. So now that means we'll have 800,000 capital that will be given for free to these existing shareholders, and blessed are these shareholders. So now let me continue on that same note, and now I go to the requirements. I know that I have bombarded you with so much information, summarizing things too much in details. I just want you to understand this too much in details because I want you to understand. 4.1 say that calculate the amount to be raised by the issue of the ordinary shares. I think we already know that. Also calculate how many ordinary shares will have to be issued to help fund the redemption, as described in the additional information number 1, number 2 of the question. Show all calculations. We already know that. We have calculated how many shares. 900,000 shares must be issued in order to finance for the redemption of preference shares. How much is the amount? The amount is 200,000. We already know that. However, let us write it in a formal way now, so that at least when you are being marked, you won't be penalized because of the bad writing. So now we have already done this. Let us just structure it so that we know how many shares and how much the capital. Remember, for you to know that, you first have to calculate how much to be paid. That is the first part. Because now they are asking us the last stage. This is the last stage, the last entry when we raise funds. This is the last entry that they are requiring us to do. But we need to first to know how much need to be paid. How much need to be raised in terms of the loan or debentures, or how much cash is available. Then after, at the end, we determine how much must be raised through the issue of the ordinary shares. So now we start to give our answers, which is, this is question 4 that I'm busy with. So now let me write that as question 4. Then we are doing 1.1. I think it's requirement 1.1. And in this requirement 1.1, yes, it is 4.1, not 1.1. This is 4.1. Now under 4.1, please don't write these questions, guys. I just want this question to be in your mind. Don't write it in the exam. We can write with the little pencil, then remove it after. The one that I'm writing now, please don't write in the exam. It's not part and parcel of the answer. It's just for you to know how much to be raised, or how much needs to be raised. how much needs to be raised / paid, or how much is owing to the preference shareholder, however you call it, how much is owing to the preference shareholder. So now either way you phrase it, but you must just have that in your mind whenever you answer this question. So now we continue, we say, okay, we know that whenever there's a redemption, there will always be capital that has to be paid back, which in this case is preference stated capital. Preference stated capital. Then you ask yourself, is the capital or are all the shares being redeemed? The question is yes, all the preference shares are redeemed. And if all of them are redeemed, you take all the capital and you redeem all the capital. But if only 70%, please calculate 70%, guys. If 70% or whatever percent is being redeemed, calculate the percentage that is being redeemed. In this case, the capital out of the 300,000 shares will be 300,000, multiply that by 4, and it gave us 1,200,000. Let me just repeat that for clarity. 300,000, multiply that by 4, it gives us the capital, because 300,000 preference redeemable cumulative shares were issued at 4 rand. So now the total is 1,200,000. And now all of them are redeemed. Therefore now the full 1.2 will be the capital that will be written here, 1,200,000 rands, which is the capital to be redeemed. Remember, once again, I'll bring you back to my scenario because I want you to be clear with this. If only 70% was redeemed, remember I used the scenario of 70%. I said if 70% was redeemed, not all of them. Let me write it. If 70% was redeemed. If 70% was redeemed. So now that will mean we say the total capital, multiply that by 0.7, which is 70%. Therefore, it means the amount that would have to be recorded here, it will be 840,000. Please don't forget this, guys, because it's very important when it comes to preference shares. I'm just using this scenario for you to understand and be able to apply it whenever you ask such question. So now you could have also calculated that from the number of shares. If you wanted, remember I'm still explaining the 70%. You could have said 300,000 if you wanted. 300,000 shares. 300,000 shares. You multiply that by 70%. You get the number of shares that are being redeemed, which is 70%. Then you multiply that by 4 rand, which is the price to get the capital. Therefore, now multiply by 4 rand, you get the same 840,000, which is the one that would have to be recorded here under the preference stated capital. So now I am passing that. I think the last time I'm emphasizing that. Therefore, now we have the premium at redemption. Premium at redemption. And our premium at redemption, I think it was 60,000 if my memory still serves me. I think it was 60,000 rands. How do we calculate the premium? Remember, the premium will be calculated from the number of shares because our premium was given in rands. And our premium was 20 cents, 0.20 times by the number of shares that are being redeemed. In this case, all the 300,000 shares were being redeemed. Therefore, now you say the premium, you multiply that by the number of shares that are being redeemed. Meaning, in this case, it will have to be 300,000 times by 20% or 20 cents. 20 cents times by 300,000. Therefore, now this means it will be 60,000 rands. That will be our premium that I've already recorded. So now, once again, I made mention of the fact that if this was 70%, this was going to be 840,000. And I said that if you were... Okay, let me ignore that now. I said that there could be a scenario where you will be given 5% of the premium, not in rands. And I said 5% in this case is the same as 20 cents. And so now if you were given the 5%, the 5% was going to be calculated on the capital that is being redeemed, which is 1,200,000. Multiply that by 5, divide by 100. That will give us the same 60,000. So now, meaning when you are given a premium as a percentage, calculate it from the capital. If it's in rands, calculate it from the number of shares. So now that I've emphasized it enough, then I can do the last part of the calculation of how much to be paid. Then it will be preference dividends. Preference dividends. Now, our preference dividends, we have stated that our preference dividends total will be 240,000. Where is that coming from? It's because we had cumulative preference dividends for the year 2009 and 2010. So now we have to add for 2 years, which was 10% of the capital, because we know that the 10%, which is 10% cumulative, that 10% is the one that is used to calculate our dividends. Always, if it's 12%, you use that to calculate your dividends. Then you say 10 divided by 100, which is 10%. Multiply that by the capital, 1,200,000. Then after it gives us 120,000 rands. And remember, we have to add the previous year and the current year. They said for both financial years, the year 2009 and for the year 2010, declare the preference dividends for the year 2009 and for the year 2010. So now they say the dividends payable for both financial years will be paid to the preference shareholders on the 28th of February 2010. That is why we need to add both of them, 120 plus 120,000 again, which is for the year 2010. Therefore, now that will give us the total preference dividends to be paid by the end of the year 2010 as 240,000 rands. So now we know how much to be paid or how much to be raised. Therefore, now I think it's 1,500,000, which is plus 60,000. Plus 1,200,000, and this gives us 1,500,000 rands. 1,500,000 rands. Therefore, now this is amount to be paid or amount to be raised. Amount to be paid or amount to be raised. In this case now, or cash required, however they call it, they will say cash required. However you call it, it does not matter for me. However, stick to what your lecturer taught you individually in your different classes. I'm just summarizing this for your own importance. So now if your lecture requires that you say cash required, please write cash required. Don't say no sense in a video said this, please. Now we continue on that same note. And now we know how much to be raised or cash required. Then now we first have to follow the instruction in terms of how now to raise funds before we reach to the last part of the number of shares. First, they said we must raise funds through borrowing money from the bank. From Auto Bank, 1,050,000. Therefore, now in doing that, we'll say cash or proceeds from secured loan. They call it differently. Proceeds from secured loan, or I can just say loan from Auto Bank. Loan from Ado Bank. I think it was Ado Bank. Yes, Ado Bank. Then loan from Ado Bank. And that loan from Ado Bank was an amount of 1,050,000. Then immediately when you raise money, you must check how much balance you have after. Minus 1,050,000. And the balance is 450,000. Then this is the balance. You don't have to write this balance. I'll just say balance 1. Then after, how are we required now to raise another money? They said there is money available in the bank, cash 135,000. Normally, some lecturers, they will start with that because it's cash available. However, in this case, it's not much of a crisis. Then after, we say available cash in the bank. available cash in the bank, cash in the bank, available cash in bank account, and our available cash in bank account is 135,000. And now let us check how much is our available balance. Please don't write this balance 1 and balance 2. I just want to make clarity when I'm doing this. Balance 1 and balance 2, please don't write that. Write what your lecture taught you to write. I just want to be clear. Ignore that part and ignore that part. So now let us check how much is our balance 2. Our remaining balance for the second calculation now, it will be 450,000 less 135,000. Then we say now our remaining balance for the second term is 315,000. What do we do with this balance now? Let us check. They are telling us that with the remaining balance, which is balance number 2, if I will call it like this, because I prefer to just say balance 1 and balance 2, so that you know that what the first balance and the second balance. So they say the balance from the fresh issue of ordinary shares at how much? At 3 rand 50 cents. And we already know that how to calculate. The capital is already known. So now the minute you know the capital, it becomes easy. Because we say, okay, how much do we need to raise? Is 350,000. And how do we raise that money? From the issue of the shares. So now we say issue of ordinary shares. Issue of ordinary shares. And how do we issue these ordinary shares? We know that it will be at price at 350. Just very small issue of ordinary shares. Now in this case we know the price, that is 3 rand 50 cents, because they told us that they must be issued at the price of 3 rand 50 cents. They the 3 rand 50 cents. 3 rand 50 is the price to be issued this shares at. Then after the minute you know the capital and the price, you can say the total capital divided by the price. Then that will give you the number of shares, which is 90,000 shares. That means we have to issue 90,000 shares. And if you say 90,000 shares times by 3 rand 50 times by 3 rand 50, then you get 315,000. It becomes easy when you know the price and when you know also the total amount. Therefore now to answer the instruction, it means number of ordinary shares to be issued. Number of ordinary shares to be issued, so that we are clear in terms of giving the answer to the question. Number of ordinary shares to be issued. Number of ordinary shares. Ordinary shares to be issued. Then that will be equal to 315,000 rands. Divide that by 3 rand 50 cents. That will give us 90,000 rands. Then we also were required to calculate the capital required. And we know that capital required, that is the capital required issue of ordinary shares. Or you can say the capital required, that is the capital which is required. Capital required. Capital required, ordinary capital required, ordinary capital required. So now that will be the ordinary capital required from the issue of shares, from the issue of shares. Ordinary capital required from the issue of shares, and the number of ordinary shares to be issued, number of ordinary shares to be issued, it is 90,000 shares. So now we have answered that. The answer and the answer, that is the marks that you'll be deserving for this question. So now we have answered 4.1, which I explain also in details. Then we go to 4.2. Then in 4.2 we are required to refer. We are required to refer, and our reference is on additional information number 2. They say refer to additional information number 1, 2, and 3, and also 4 in the question, and give all the general entries, not some, all of them. Don't leave anyone. 1, 2, 3, and 4, all the general entries of Coco Limited to record the redemption and its financing in full. Narrations are still not required once again. That means they are not important. Therefore, now let us just do that. Then after we do that, we see what is the next question that we have to do. So now we are recording from number 1, number 2, number 3. We are doing number 1, number 2, number 3, and also number 4. All the general entries that are in those transactions. Number 1. In number 1, what I can see in number 1, there was a meeting by the board of directors, and in that meeting they redeemed the preferences, and they also in that meeting declared the preference dividends for 2 years, 2009 and 2010. Then after both of these dividends for the both years, they were paid in the year 2010, which is the current year. Then after, there was no money available to pay for the redemption, which was declared in a meeting in the first and second entry. Then after, they said because there's no money, we need to raise money. Then that is what I know so far. So now let us start from number 1 and number 2 before we go to number 3. Number 1 is when the company starts to declare the redemption and declare preference dividends. Then number 2, they raise money for the fact that there's no money available to pay for the redemption of preference dividends. There's no money available to pay for the preference dividends that the company declared to redeem to the existing preference shareholders. So now let us do that. First of all, we know how much we owe. We already know that we need to pay an amount of 1,500,000. We already know this. That's why now they ask us this question. So now the only thing that we do, we take this information, we record it in a general entry format. Please don't forget the fact that there is a dividends tax, and I always want to include this when I'm doing this entry. Don't forget that there is a dividends tax which is calculated at 15%. There is our dividends tax at 15%. I want to include it in the first entry so that we don't struggle as we go further. So now we are doing number 1, 2, and number 3 at the same time, where we account for the dividends tax when we do the journal entry, when we raise this liability. First of all, we need to raise a liability, rule number 1. Then secondly, we raise funds. Thirdly, we make payment. That's it. First of all, we are doing 4.2. First, we raise funds. We declare the liability, raise the liability, raise funds, then we make the payment. Now, we first have to raise liability. Raise liability. Then please also don't write this. I just want you to understand this is what you first have to do. So now we are raising a liability in this entry, and when we raise the liability, we debit our preference stated capital, debit our preference stated capital. Our preference stated capital, it is an amount of 1,200,000 rands. That is what the company is paying. Then after, we have the premium at redemption. Our premium at redemption, we know that our premium, it is an amount of 60,000 rands. Then after we calculate our preference dividends, and we know that our preference dividends, it is an amount of 240,000. Remember, dividends tax was not yet accounted here, so now we need to account for the preference dividends. So now it means our dividends tax, that means our preference dividends must not be inclusive of the dividends tax. However, other journal entries, they combine here and they separate in a separate journal entry, but I prefer to separate it from here. So now that means out of the 240,000, which is my preference dividends that I calculated for 2 years, out of the preference dividends of 240,000, I have to say how much is dividends tax. Dividends tax is 15%. Then we say 240,000, multiply that by 15%. That means the dividends tax or normal tax dividends tax is 36,000. Remember, this is a liability due to SARS because of the declaration of the preference dividends. So now it means our preference shareholders will receive dividends of 240 less 36,000. Then you say less 240,000. That means the amount of the preference dividends is 204,000. So now that is why I will record here 204,000 immediately, so that my amounts are exclusive of the dividends tax. Then I record 204,000. Then this is my preference dividends. Then after now, I will have to raise a liability now. Then when we have to raise a liability, I have to credit my preference shareholder. I credit my preference shareholder. My preference shareholder will be the total of these amounts, which is the total of 204,000 plus 60,000 plus 1,200,000. That means the preference shareholder will receive a lump sum of 1,464,000. This is what will be paid to the preference shareholder. And another portion, which is 36,000. 36,000, we calculated that to be a dividends tax or normal tax dividends tax that is due to SARS. So now if it's due to SARS, it must be separated and it must be a separate liability. Therefore now that is why we credit now our tax, which is current tax payable dividends tax. Current tax payable, that will be dividends tax. Current tax payable dividends tax, and that is 36,000 rands. So now make sure that at the end your total debit side is equal to your total credit side. Always when you do a journal entry. If you say 1,464,000 plus 36,000, that gives us 1,500,000 rands. So now let us check if the debit side also gives us the same amount. 1,464,000 plus 36,000. Then after we say 1,200,000 plus 60,000 plus 204,000. What went wrong now? 1,200,000 plus 60,000 plus 204,000. It gives us 1 million. Okay, let me check. What am I doing wrong? Okay. Now on the debit side, we still record the full 240,000. We don't split that. We record that 240,000 as it is. So confirmation is always important. We record the full amount of the preference dividends as 240,000. However, when we make the payment, we know that we'll only make the payment for 1,464,000. Then after we also pay tax to SARS. So now, though we know that 24,000 is the amount of the dividends, but we still record the full amount which was declared here as 240,000. So for that, then after we still record the total of 36,000 as the tax. Then after 1,464,000 on the credit side, which is the amount, because this is the amount that is due to the preference shareholder, because dividends tax is going to SARS. So now we still record that as the liability. So now our liabilities, there are two liabilities. Liability due to the preference shareholder and liability due to SARS, which is the revenue service. Then now from here we can raise our funds. And when we raise our funds, we start with the bank loan, because there was an instruction that you must raise money through the loan of the bank, and that was Auto Bank. And that was an amount of 1,050,000 that we instructed to raise. And whenever you raise money from the bank, you debit the bank. Then after, it will be 1,050,000 rands. Then after, we credit our loan, and that will be loan : Auto Bank. So now we have acquired the loan of 1,050,000, and immediately when that is acquired, then we can now go to the second part of raising funds, 1,050,000 rands. Then we know that there was cash available in the bank. There is no journal entry for the cash available in the bank. And the second entry was to raise money through the issue of ordinary shares, where we issued ordinary shares, and that was debit our bank, and it was 315,000 rands. Then we had to credit our ordinary stated capital. And our ordinary stated capital is 315,000 rands. Then we have raised all those. Remember, they come from what we have just done previously in terms of raising funds. We raised the loan 1,050,000, and we raised the cash, and that was 100 or 350. There was 350 that has to be raised through the issue of the ordinary share. So now these are the two. We just do them in a general entry format. Then after we have raised our funds, then after raising funds, now we can make the payment. I hope there is no other thing that we need to take into account except only the share issue cost. I think there was share issue cost of 12,000 rands. Yes, there was a share issue expense of 12,000 rands, and that share issue expense must be taken into account against ordinary stated capital, because it was based on the share that we issued. So we debit our ordinary stated capital, because this is an expense that has to do with the issue of shares. Then we credit our bank because it was paid. Then after, that will be an amount of 12,000 rands. 12,000 rands. So now we have done that journal entry. The last journal, or the journal entry that must be done, which is the last one, is the payment. We first have to raise the liability, and this was where we raised the liability. And in raising the liability, the capital must be there, the premium must be there, the preference dividends were supposed to be here. Then after, we credit our preference shareholder only with the amount that exclude dividends tax. However, if you want to combine it, it's not a problem. Then you can have two separate journal entries. Maybe your memo might be different. Please do it in any way that you are comfortable with, but I prefer this approach. Then after, you credit the current tax, which is the dividends tax that is due to SARS. Then after, we make the payment. So now when we make the payment, what we do, we know that we have two liabilities. There are two liabilities that are here on the credit side. When we make the payment, all that we do, we just debit the liabilities and we credit our bank account, because we are paying what we are liable to pay. We are paying what we were liable to pay. And what we're liable to pay were the liabilities, which is the preference dividends or preference shareholder. And then after, we're also liable to pay the amount of tax which is due to SARS. So now let us make that payment now. And when we make the payment, we will debit the liabilities, preference shareholders, debit preference shareholders, debit preference shareholders, and we debit normal or current tax payable, normal dividends tax, current tax payable, dividends tax, and our current tax payable dividends tax is 36,000, and our shareholders, our preference shareholders is 1,464,000. That is the liability that we are paying. We are paying what we are liable to pay. You can never pay something that you're not liable to pay. First be liable before you pay. So now in this case, we are paying only the two liabilities. And now we've debited the liabilities, and obviously our bank account will have to be credited. And we credit our bank account by an amount of 1,500,000 rands, which is the sum of the debit side, 36,000 plus 1,464,000. That gives us 1,500,000 rands. So now a payment has been made. We go to the last requirement and the last journal entry before we do the statement of changes in equity. Then now the last journal entry before we do the statement of changes in equity is 4.3. And 4.3 says that refer to additional information number 8 only in the question and give the journal entry of Coco Limited to record the issue of the fully paid up shares on the 28th of February 2010. We have already done that. We knew that if there is capitalization, we have to record 800,000 rands, and that will have to be debited our retained earnings, and we credit our ordinary stated capital because these were the ordinary shares. So now let us first calculate calculate back that 800,000. If how we calculated that, we said the number of ordinary shares, just to refresh, the number of ordinary shares that were in the share register on the 1st of January 2010. And we said the only shares that were in the register by that date, it was only the ones that were issued by the 1st of March 2009. So now it means the ones that were issued on the 1st of January 2010, which were issued because of the redemption that took place in number 2 and number 3, and these were issued here, they are the one that they are referring to. So now that means that 90,000 which was issued on the 1st of February obviously was not in the share register, meaning this 90,000 shares that were issued because of the redemption or to finance for the redemption will not be included. I'm just rephrasing this again because I did emphasize on that. Meaning now we only take the 800,000 shares that were already in the share register. That means already issued by the 1st of January. So now it will be 800,000 divided by 4 times by 1. That will give us 200,000 shares. We divided by 4 because the 4 is this one. They said the shareholders will receive 1 share for every 4 shares. So now hence we said divide by 4 times by 1. And we multiply by the price. And our price was 4 rand, and that gave us 800,000 capital that the company will pay for free to the existing shareholders. Therefore now that will be 4.3 that we are doing. Then we said we have to debit our retained earnings because the company will take money out of the reserves of the business. Retained earnings, and our retained earnings will be an amount of 800,000 taken out of the retained earnings. Then the ordinary stated capital will increase. Ordinary stated capital, that means the money is taken out of the reserves into the capital account. Ordinary stated capital, which will be 800,000 rands. So now this is what will be done under 4.3, and it ends there. There's nothing else. You can perhaps show the calculations if you want somewhere where you first have to say can just first to say 800,000 times 1 divided by 4. That will give us 200,000 shares. Then 200,000 shares, to multiply that by 4 rand, then it will give us 800,000 rands. So now we have touched based on that. Then we go to the last part, which is another bigger portion that counts for marks, which is the last part now that I will be doing in this question. All others, guys, if I have time, I will do them later on. Then this is 1.4. The statement of changes in equity. Statement of changes in equity at 28th of February in the year 2010. At 28th of February 2010. So now we know that our statement will start with the ordinary stated capital. Ordinary stated capital. Then after we have preference stated capital. Preference stated capital. Preference stated capital. Then after we have retained earnings. Remember, in this case, guys, I did not see any of the revaluation. So if there's no revaluation, there's nothing to worry about something that is not there. That's why I will not even record a revaluation surplus, because it is not there. Unless it was hidden as a secret that need to be revealed. Then after we have the total column. Starting with the opening balance on the 1st of March 2009. That was the beginning of the accounting period, opening balance. That will be opening balance. Opening balance in terms of ordinary stated capital, we go and check how much capital was already there by the 1st of March in the year 2009. That opening balance, it is 2,500,000 rands. 2,500,000 rands. 2,500,000 rands. Preference is 1,200,000. Preference capital, that was already there, where we said 300,000 times by 4, that gave us 1,200,000. Then there was a retained earnings somewhere of 800,000, if my memory still serves me. Yes, there was retained earnings somewhere there, 800,000 at the beginning of the year. Then the retained earnings, it is 800,000 rands. And if we add the two, that will be 800,000 plus 1.2 million plus 2.5 million. That will give us 4,500,000 rands. 4,500,000 rands. Then after, let us check now if can we record the entries. Let us start with the capital, which is total comprehensive. Start with the total comprehensive. Start with the total comprehensive, which is the profit. In fact, our total comprehensive income, it was an amount of 700 and something. Our total comprehensive was given, let us check, yeah, under number 7. Total comprehensive was 760,000 rands. So now we take that as it is. Remember, there's no revaluation surplus, so we just record that under retained earnings, 760,000, and it must also go under total. Then now we go to the next one, and the next one will be, let us start now with our shares now, because that's what we have to focus into. There was first a right issue. Let me start with the right issue. Right issue of ordinary shares. Right issue of ordinary shares. right issue of ordinary shares, right issue of ordinary shares, and the right issue of ordinary shares amounted to 315,000. Remember, there was a right issue that was issued because of the financing of the redemption. This was the right issue where we issued shares here, and these shares, there were 90,000 of them. We said it will be 90,000 of these shares that must be issued, and they will be issued at a price of 3 rand 50. 3 rand 50, we multiplied that long time by 90,000, and that gave us 315,000. So now let us just record that as it is, 315,000, and go straight under total again, 315,000, because there's no other column that affects ordinary except the column of ordinary. Then there was a capitalization issue. There was capitalization issue of ordinary shares. Then let us record the capitalization issue of ordinary shares. Capitalization issue of ordinary shares. Capitalization issue of ordinary shares. Capitalization issue of ordinary shares, it was 800,000. I still remember this. It was just fresh from now. 800,000, 800,000, and 800,000. Let us just confirm it if it was 800,000 honestly. We just did a journal entry for that. There was the capitalization issue. And number 3, it was 800,000 rands, ordinary stated capital. Then now the reason why, guys, we say ordinary stated, we don't say capitalization, is because there's no account called capitalization. We issued ordinary shares at the end of the day, but because they were issued for free and the name for that is called capitalization. However, we issued ordinary shares. That's why now the contra entry will be ordinary stated capital. Also together with the right issue. We don't say right issue because there's no entry called right issue, because the right issue was on the issue of ordinary shares. So now ordinary shares were issued, either they were issued at a lower price than the market price. At the end, ordinary shares were issued. That's why now the contra entry will remain ordinary shares, either the right issue or the capitalization issue. So now let me go to the next one, which is the share issue expense. Before we do the redemption, there was an expense to issue these shares above, which was the right issue. Therefore, now let us record that share issue cost or share issue expense. And the share issue expense, I think it was an amount of 12,000 rands. Share issue expense, ordinary share issue expense, because it was for ordinary shares. Ordinary share cost or share issue cost, ordinary share issue expense. I hope you'll accept me with my writing. Sorry, I just have to squeeze things. As long you see the figures and the writing, and I'm explaining the writing. Ordinary share issue expense is 12,000. It affects our ordinary stated capital negative because this is an expense with regard to the issue of ordinary shares. So now it has to be negative under ordinary shares. Then if it was for preference, then it would have to be negative under preference. But there was no share issue cost for preference because obviously there were no preference that were issued. They were just being redeemed. Then now the next one will be the redemption, which is the key one now, redemption. Then we record redemption of preference shares. Redemption of preference shares, because only preference shares were redeemed. Redemption of preferences. Redemption of preferences. And the redemption of preference shares, it was an amount of 1,200,000. All the preference shares were redeemed. 1,200,000. Then now there was a premium on top of that, and the premium was 60,000. Please make sure that you record the premium in the same line of the redemption. Then we have recorded the capital and the premium. Then after the total will give us the sum of the two, which is 1,200,000 plus 60,000. Then this gives us 1,260,000. 1,260,000. So now that says to be negative, remember, because we are calculating all these amounts are negative. The total will be negative too. Then after we record now our, let me just emphasize this because I did make mention of it during the time. Remember now, if only 70% was redeemed, so now you'll only have to record the 70% here, because in the 70% that we calculated, we said 70% would have been 840,000. So now that means 840 will be recorded here and 42,000 would have to be recorded here, if you still remember the scenario that I brought. But all of them were redeemed, therefore now amounts remain as they are. I just want to be consistent with my scenario now, so that you get to build understanding in terms of where I wanted you to go. Then now the last one is the preference dividends. The last one is the preference dividends. The last one is the preference dividends. So now preference dividends are recorded as the full amount. That is why now also in the journal entry where I just made a little bit of a mistake, that is why in this journal entry we have the full amount of the preference dividends recorded as it is, because we have to take this amount and you record it in the statement of change in equity, the amount that is inclusive of the dividends tax, because dividends tax is still inside here. You don't remove this dividends tax, you record it, but you record it in a separate entry. So now here is our preference dividends as we calculated them. Then we take that 240,000 that include tax and we record that under our retained earnings. Then it will be recorded as negative 240,000 rands. 240,000 rands will be negative here. Then now under total it will be the same 240,000 rands. 240,000 rands. So now we have recorded all that was needed to be recorded for this statement of change in equity. Then I can just draw a line here, then we calculate the totals, and we just have to make sure that everything balances by the end of the accounting period. Don't forget that the closing balance is at the end of the year. Then this will be 28th of February in the year 2010. Then it will be closing balance. I normally forget this, I want to write it now. Closing balance. And the closing balance now will give us the total of ordinary 2.5 million plus 315,000 plus 800,000 minus 2,000, which is 12,000. That gives us 3,603,000. 3,603,000. With regards to preference, all of them were redeemed. So 1,200,000 less 1,200,000, there is nothing at the end. Then after, under our retained earnings is 800,000 plus 760,000 minus 60,000 minus 240,000 preference dividends. That gives us 126. That gives us 110. Let me check, what did I left behind? Okay, capitalization, yes. Capitalization, I forgot something. Capitalization is 800,000 recorded under retained earnings. I was just contradicting myself now. 800,000 is recorded under retained earnings. If you have spotted the error, thank you for spotting that, because I know some of you would have spotted this when I recorded this in the wrong entry. That's why it's important to listen to the video until the end, because sometimes you might miss things that were corrected along the way. Remember, the amount of the capitalization was taken from the retained earnings, and if I can link that with the journal entry, we debited retained earnings. Look here, retained earnings is debited. It's an indication that retained earnings will be reduced because retained earnings increase on the credit side and decrease on the debit side. So now the minute we reduce our retained earnings on the debit side, that must be reflected as negative in the statement of change in equity. So now it becomes negative and there's nothing under total. So now we have recorded that. However, our capital still has to increase because capital increased by the amount that the company paid for free to the existing shareholders. That does not change, but it must be under retained earnings. Then after we say now less 800,000, then this will give us 460,000 as the total, 460,000 rands total on the retained earnings. Then now we go to the total. We go to the total column. Then under total now we have 4,500,000 plus 760,000 plus 315,000 minus 12,000 minus 100 minus 1,260,000 minus 240,000. This will give us 4,063,000. 4,063,000. Now take note of the fact that under the total for the capitalization issue of ordinary shares, there is nothing. Why? Because 800,000 is positive, less 800,000, then that will give us 0 under the total. That's why there's nothing. If you want, can write 0 at the end, you'll get the same amount. Guys, with that being said, yeah, I hope you'll enjoy this video and you'll understand something out of it and learn something and apply that wherever is necessary in the exam. So now this balance at the end, let us confirm if does it align when we calculate on a vertical or horizontal perspective, where we say 3,610,000 and we say plus 460,000 and we get to the same amount, which is 40,063,000. 4,063,000. 4,063,000. So now it is the same 40,63,000 and we have recorded that correct. And with that, guys, bye bye. God be with you. Thank you.